Hello and welcome to a Tuesday edition of FreightWaves Now. Boy, do we have a good show for you. Besides covering the disruptive weather conditions with Chief Meteorologist Nick Austin, we are also talking to you about economic data with Ibrahiim Bayaan, who is really going to tell us a lot what's going on with manufacturing, a mystery that many of us are trying to solve each and every day. And also John Paul Hampstead is going to give us an update from the Covenant earnings reports for quarter one and what that might mean for other carriers in the market going on into this year. Without further ado, let's begin. Hello, Nick Austin.
Hey, Chad.
Hi.
Well, we have rain right where we don't need it today. In the Midwest, where there's been the devastating, historic, and truly historic flooding across parts of Nebraska and Iowa, right along the Missouri River. It's not real heavy rain, but they don't need any rain at all, but a batch of it is moving right across that area from Omaha down to near Kansas City and parts of southern Iowa. So that's just going to add to more of the flooding problems. Now, in some areas of that region, the water is starting to recede, but not everywhere. Some rivers are still rising and swelling above their banks, and there will be more flooding over the coming days. So definitely disruptions there, but in the areas, some of the hard-hit areas where mud has been cleared off the streets and the water is gone. The high water, trucks from local area trucking companies, local area grocery chains that have trucks that are donating food and supplies have been able to get into some areas. So that's good news, but there are going to be still trouble spots through the week. And on rail. Yeah.
The rails are
some of the rails
can't go through because of the flooding right now.
They're closed.
Right? Some
of the rails are washed out. BNSF as well as Union Pacific in that region, some of their rails along their networks are out of commission. So they can't send anything on there as far as anything on rail. So the trains are going to have a hard time too. So this is going to be an ongoing problem.
In that area?
Yeah, even after this little batch of rain leaves, there's still going to be flooding problems, possibly even further downstream, maybe towards St. Louis and into Kansas City and a little bit further south. Because of more snow melt upstream and just all of the runoff. The ground just can't hold all the water. So it could take the rest of the week or maybe even into next week and till the end of March before the flooding is gone from all of the areas in that region.
That's pretty significant.
So,
what else? Anything else happening throughout the rest of the United States? That's the main disruption?
There's heavy rain as well. There could be flash flooding in parts of Central and South Florida. Not major flooding like what we're seeing in the Midwest.
Okay.
But just because of heavy rain today and some thunderstorms, maybe flash flooding along the I-4, I-75, I-95 corridors. But the rest of the country is nice and quiet for the most part. Yeah.
Great. All right. Thank you, Nick Austin. Everyone likes to talk a lot about the weather, but nobody seems to be able to do anything about it. Let's go over here and meet up with Ibrahiim Bayaan. Hello, Ibrahiim. Welcome.
How you doing, Chad?
Doing great here in headquarters 2, Freight Alley in the shadows. How are you doing?
I'm doing great.
Great.
So what I wanted to talk a little bit about today is manufacturing. I mean, I think people, when they look at freight data at the start of this year, they've noticed that it's tailed off quite a bit, especially when you compare it to how things were last year. And part of the reason behind that is that I just think there's not as much demand growth out there as there was at this time last year. And so, the biggest thing to note is that, like, when you think about freight demand, manufacturing makes up the majority of it. I mean, you think about like all the goods that flow through the economy, either it gets imported into this country or it gets manufactured here. And the amount that we manufacture domestically is far larger than what we import from the rest of the world. And so I keep pretty close tabs on the manufacturing sector because it gives pretty good insight onto what the state of freight demand is going to be. And so here I have industrial production, manufacturing, and you can see
year-over-year change. Yeah. And how many years are we looking at?
This is about 5 years worth of data.
Okay.
And so if you go back into 2016, you can see like the last time there was a freight recession in the economy was in 2016, where growth in manufacturing was negative about 2% year over year. And we've since kind of gradually accelerated out of it.
Right.
2017 was a pretty good year. Towards the end of 2017, you start to see strong growth, and you get multi-year highs in growth rates by the time you get to the middle part of 2018. In fact, by the time you're at like the end of the third quarter, you're looking at growth in manufacturing that's about 4%, a little bit less than 4% year over year. But since then, the data's just turned south and fairly quickly. You can see here the year-over-year growth rates have tailed down considerably. As of February, sorry, it's just 1% year over year. And again, this is year-over-year change. If you actually look at like the levels of manufacturing and how they're performing, manufacturing is essentially flatlined in the economy. And so one of the reasons why freight demand is not doing so well, the manufacturing sector is not doing as well either.
What do you attribute it to? Do you know some of the why, or?
Well, there's a lot of different reasons. Part of it is just that there isn't the same kind of appetite for business investment this year as there was last year. Businesses got a big boost from tax cuts last year. They also had prospects for stronger growth in the economy, so they felt pretty good about investing in the economy. That fuels a lot of manufacturing demand. The export sector is also a big contributor to manufacturing, and that hasn't been performing as well either. So the combination of just like slower business investment and slower export growth weighs down the manufacturing sector overall.
Can you project this at all? Do you think this is continuing to go down? It's still relatively high.
Well, so it's a good question. I think the worst of it is probably taking place in the first quarter.
Okay.
There were a couple of temporary things that happened in the first quarter. There was the government shutdown, which made businesses a little bit uneasy in the first quarter. Some really poor weather once you got to like the end of January, beginning parts of February, that just hammered the central part of the country. That also disrupts manufacturing activity.
Okay.
So I think once you get to the other end of it, you probably see better growth. I just don't think it's going to climb to as high as what it was, say, last year, in the middle part of last year. So some more data to kind of reinforce this. This is data from the Institute of Supply Management, their manufacturing index. I like to reference this quite a bit. It's just survey data of manufacturers to ask them how business conditions are doing. And any reading above 50 generally means that the sector is expanding. Once it falls below 50, it means it's contracting.
Right.
And so you can see, again, a similar kind of pattern in 2016.
And that's why you pulled up this baseline of 50 for us to know. Okay.
Absolutely. And you can see, like, again, in 2016, it dipped into negative territory. This coincides to when the manufacturing sector overall was contracting. You can see a similar kind of acceleration in the ISM data. And again, multi-year highs once you get to the middle part of 2018. But since then, it's come down. Right? Now, again, you're not in contractionary territory yet. You're still at 54.2. That's a decent reading, all things considered.
Okay.
But it is the lowest reading that we've had in a couple years. I mean, you'd have to go back to, say, before the 2016 presidential elections to find a reading as low as where we are right now.
Right. So
just another sign that, the economy is losing some steam, especially in the manufacturing sector. So again, to further drive this home and to take a look at sort of what the outlook might look like, this is a measure of new orders in the manufacturing sector. So this also comes from the Institute of Supply Management. So again, similarly, anything above 50 means that orders are expanding. If it falls below 50, orders are contracting. And a similar sort of pattern, you can see this is just sort of the last year or so of data. But you can see that the values have weakened quite a bit. And once you get to like December of last year, new orders were essentially at this 50 threshold, like just barely above this 50 threshold. Now they've come up since then, and so I think going forward you'll start to see a bit better manufacturing activity. New orders usually leads actual production by a month or two, so if you see weak readings in December, that coincides to weak activity in January, February. And so the idea that the fact that the numbers have come up a little bit suggests that manufacturing is probably going to come up a little bit also.
Okay.
But again, still this decelerating trend that we see in the manufacturing sector.
Yeah. Boy, it shot up there in January before falling a little in February.
Sure. And so this is to give you some, the ISM data is like survey data. This is to give you more concrete data on new orders in the economy. This is durable goods orders for the manufacturing sector. And again, you can see this tremendous run up in the number of orders that you experienced in 2017, 2018. But then when you get to the end of 2018 into the beginning parts of 2019, you get this stalling activity in the number of orders. Right? So again, just reinforcing this idea that manufacturing activity has slowed down quite a bit at the start of this year. And so when you're looking for reasons why freight demand growth isn't as strong this year as it was last year, I think part of it is just, when you look at manufacturing trends, there's just a lot less activity going on in that very important sector.
I think that recently a report came out that said retail spending was surprisingly higher than expected through January. What do you feel like overall about the health of the U.S. economy right now? This is a very interesting take on what we're, the trimmers and what we're reading for manufacturing. What about the overall health of the U.S. market right now? How do you see things?
Well, I mean, I think the economy overall is going to be okay. I just think people need to adjust their expectations after what was a really strong year of growth last year. Like 2018, in a lot of ways, across a lot of different metrics in the economy, was just a very strong year. And so this year it's not going to be that again. Like, I think people have to get used to this idea of slower growth in the economy. I'm not one of those that thinks like a recession is imminent. There are risks out there that might push us into that sort of thing.
Okay.
But service sector activity is pretty strong in the U.S. economy. That usually helps sustain growth in the overall economy. So I think the economy will be okay when it's all said and done. But that's not to say that the freight economy is going to be okay necessarily. Like the freight economy and the overall economy, they move together sometimes, but sometimes there's divergences. And I think a lot of the indicators that relate to freight demand and the amount of goods that are flowing through they're trending downward. And so, look at manufacturing or exports, retail's still doing okay, I think. But I think that side of the economy is going to do much slower than what the overall economy is going to do in 2019.
Thank you so much, Ibrahiim Bayaan, our economist, our specialist. He's bringing it to us each and every business day, and we are talking about, well, what could be trending down now? Could we be in a cycle where maybe the U.S. economy, in spite of a few risks, may be resilient, but could the freight economy be in something of a retraction? Let's find out about the latest update from John Paul Hampstead. What's up?
Hey, Chad.
Hey.
Yeah, so I think Ibrahiim was speaking earlier about the softness in some of the leading indicators for the freight economy. And we think now that publicly traded truckload carriers are finally starting to feel some of that pain. Yesterday, after trading, Covenant Transport, stock ticker CVTI, issued a first quarter update saying that they were probably going to miss expectations for their earnings in the first quarter. Wall Street consensus expectations were 36 cents a share. Covenant is now saying that earnings will probably come more in the 18 cents to 26 cent range. They attributed that to a number of different things. Interestingly, the one thing that they didn't blame was the macroeconomic sort of backdrop. They said, there was a hangover from tariff pull forward. They said that there was really bad weather. A couple of these sort of like incidental things that it's nobody, no one's real fault. And they were kind of, I think, a little probably too careful to kind of avoid these larger structural issues. One of the things that they didn't talk about that we think actually probably had a material impact on earnings this quarter was fuel surcharges. And if you remember, large truckload carriers essentially buy fuel at wholesale prices, what they call rack prices. And rack just refers to the sort of the gas station of the gas stations. It's where the pilot truck fills up before it goes with diesel before it goes to the truck stop to fill that up. They buy fuel at rack prices, but the shippers reimburse them through the fuel surcharge at prices pegged to DOE, Department of Energy, retail prices. And those prices aren't always the same. Obviously, wholesale and retail are different, but the amount of difference changes a lot. And the wider that spread, the more sort of free money the truckload carrier is getting from the fuel surcharge. So what we've pulled up here is fuels.usa, and it's just the spread between the retail and wholesale diesel in the United, and this is an average for the entire United States. You can see sort of at the end of the fourth quarter in 2018 and kind of going into the first quarter, the spread was as high as $1 and almost $1.35 a gallon. That has since fallen off quite a bit. So one thing that Covenant is no longer enjoying is a wide spread between wholesale and retail prices. That should affect pretty much all publicly traded truckload carriers. The next chart, though, is actually more specific to Covenant's business. And what I mean by that, I'm talking about the 900 or so team drivers that Covenant uses. This is where you have 2 drivers in one truck They specialize in expedited freight that has to move, a long length of haul really quickly. So the idea is that 2 drivers can keep a truck rolling almost 24/7 and cover, far greater distances than a solo driver. And when we look at expedited freight and we look at the demand for expedited freight, one of the great proxies is air cargo. So we pulled up this chart, which shows US dollars per kilogram in air cargo from Hong Kong to North America. And you can see, we're peaking again in the fourth quarter of 2018, well above 550 a kilogram, now dropping, pretty much really fast in the first quarter. So, I think this is fairly seasonal, but it tells our view at FreightWaves is that expedited freight is the first kind of freight to sort of see a demand fall off when economic conditions soften and when freight volumes soften. At this point in the year, we're about 4% below year over year for outbound tender volume index for the entire U.S. And I just think that early on last quarter, the story for the truckload carriers was that their dedicated business, their contract business will insulate them from what everyone knew was a soft spot market. But now we're starting to see that, okay, Covenant said the revenue per tractor per week is off, miles per tractor are off. They did say, and their year-over-year comps to the first quarter of 2018 are a little, kind of wacky because they had a big land air acquisition. But if you remove that, David Parker said in the first quarter update, David Parker, the CEO of Covenant, said that their consolidated freight revenue was 5.5% up year over year. What does consolidated freight revenue mean? To me, that means truckload and brokerage combined. And so they might be making up for some softness on their asset side with growth in their brokerage. But the thing about revenue with what you really care about with brokerage is gross margin, not revenue. So you can pump your revenue numbers, especially if you're combining the asset heavy and the asset light sides to kind of hide a revenue miss in a way. But the story is in the earnings, and this company is much less profitable in this kind of environment than it was even a quarter ago.
Thank you, JP. Appreciate it. That is what is happening right now with freight conditions. Volumes still trickling down slightly now, 4% year over year underneath what it was. As we were strong. Now lately we have been trending downward a little bit. Rates still remain low. What is going to happen? Well, we've been trying to cover it for you each and every day, and that's why you need to stay tuned here at 4 o'clock Eastern Time, my favorite time of the day. We are also, find us on FreightWaves Now, find us on Twitter and in social media, share the love, and in the meantime, don't worry, be happy.